So, you've heard the term investing and you've decided you want to invest. But what does that even mean? Where do you even start? If you've been asking these questions, then you're at the right place. My name is Ognian Stanoev, and this is the first video in my complete Investing for Beginners guide. In this video series, we will go from confusion to clarity. As a person who has achieved financial freedom through investing, my goal is to get you from zero knowledge to having a good overview of what investing is, how to invest, what different types of assets there are, and how to decide which ones to choose, common mistakes, and more. By the end, you'll be able to make an informed decision about your financial future and will be crystal clear on what your next steps should be. So, let's begin with the basic question. What is investing? For the purpose of this series, we will only talk about financial investments. I know a lot of people say they invest their time into something or invest it in a vacation or a laptop, etc. This is not what we will be talking about. We will only talk about investing money here. Okay, so first you need to know that there isn't an exact definition, but generally investing means putting your money into something and expecting a return from it, while at the same time having at least a little bit of risk. Two important terms here: return and risk. Return is basically what you get from your investment. If you invest $100 and you get 10 back, you got $10 from your initial $100 investment, or 10%. Every single person who invests expects something in return, otherwise there will be no incentive for them to invest in the first place. Okay, what about risk? Risk is the possibility of something going not the way you want it to. From that stranger in the bar not giving you their phone number, all the way to a car crash, risk is an inevitable reality of our life. This is an important lesson you need to remember. There is no removing risk, only managing it. The same applies to investing. When you're putting your money at risk to get return on it, you are assuming there is some risk. Imagine it like this. In order for you to make anything you want to happen, a movement needs to be involved. Either you need to move or something else in the world needs to move so that a result can be produced. Same goes for your money. When you're putting your money to work, something moves in the world, and that movement is what brings you results. But just like with getting up from the sofa to get that cup of water, there is a chance you might slip and fall on the floor. That doesn't mean you should not drink water. It just means that you should be looking at your feet when you're walking. This is also the case with investing. A lot of people are paralyzed when they hear the word risk, when they don't realize it's the same with driving a car or getting outside. If you want something to happen, you need to do something. If you want a return on your money, you need to invest your money and let it move, so to speak. With all that said, generally what investors do is buy assets like stocks, cryptocurrency, gold, or real estate, all of which we'll talk about later in the series. So logically, the next question we need to answer is, what is an asset? To put it in layman terms, an asset is anything that can be useful. For example, if you have a piece of wood, it can either be burned to generate heat or carved to create a useful tool. In the world of finance, an asset is anything of economic value that can be expected to provide an economic benefit. So, when investors buy assets, they hold them for the long term, expecting to either generate cash or sell at a much higher price later. If investors are looking to purchase an asset that generates cash, like rent from a house or dividend from a company, then that is the purest form of investing, where you buy something that generates value for society and you receive a reward for that. It is a pretty simple concept that everyone can understand. On the other hand, if investors are looking to purchase an asset and then sell it at a later date for a profit, the line with trading becomes a bit blurred, but this is still considered investing. In that case, the investor is looking for something that is undervalued according to them, buy it, hold it, and then, when they think it is overvalued, sell it and make a profit. Not complicated at all, right? Yeah, well, at least until you try to do it, but more on that later. So, putting your money to work in an asset, expecting it to generate return while carrying a certain amount of risk. Now that you know what investing is, let's answer the most important question. Why the hell should you even invest? In order for you to even start investing, it's a good idea to know why. And no, it's not as simple as, I want to make more money. There are 5 reasons why you would want to start investing, and here we will explore all of them. People usually fall in 2 camps. They don't even know the reasons someone invests, and so they don't bother doing it. Or they vaguely know they should, but because they don't have clarity on why, they're not motivated enough to start. Now, I will put you in the 3rd camp. the camp of people with crystal clear reasons that easily turn into action. As I mentioned, there are 5 main reasons to invest. The first is that you might want to grow your wealth to reach a specific amount for a specific goal. Note that I said specific. Too often I see people who invest in assets that don't pay any cash to them, like a rent or dividend. They have no plan to take advantage of the profits and they don't know when or if they will ever sell. I will talk more about why this is a flawed way of investing later in the series, but for now, to keep it short, let's just say that to me, just watching a number going up and down on a screen for 20 years without any strategy or a plan for what to do with the money is ridiculous and dangerous. However, if you have a certain goal, for example, building a house, then this changes things. It is a totally okay strategy to pick certain types of investments that you think will grow a lot in the coming years, invest in them, and wait. Whether you invest every month from your salary or a lump sum of money once doesn't matter that much. The idea is that you have a plan and a goal. Once your investments reach the X amount of money it will cost you to build a house, you sell these investments, build the house, and you've achieved your goal. The same can be done for the education of your kids or whatever else you want. The second reason is investing for passive income. Unlike in the previous case, here the idea is to buy assets like rental properties or dividend-paying stocks that pay you month after month and hold them forever. With that cash, you can do one of 3 things. First, supplement the income from your job. Second, reinvest the cash to grow your investments and future passive income, also known as compounding snowball effect, which I will discuss in another video. And third, use the passive income to pay for the life you want to live, thus achieving financial freedom, which is usually the last stage of an investor's journey. All 3 goals are possible with the right investment tools, and this is a major motivator for a lot of investors, including myself. The end goal is to have a money-making machine that never stops and pays you for all your expenses while you're free to live the way you want to live. This reason to invest overlaps with the third one, and that is investing for retirement. However, they are not the same, and so I have separated them. Some people like to follow something known as the 4% rule, where you don't invest for passive income but sell 4% of your investments every year once you reach retirement. The idea is that if you do that, your money will never run out. I'm not practicing it and I'm firmly against it, but that's a topic for another video, and I have actually discussed this at length in my FIRE or Financial Independence Retire Early videos on my YouTube channel. However, it's being practiced by a lot of retirees, so I'm including it here. Another way to fund your retirement is through the already discussed passive income that is paying for your life. Now, here a lot of people might ask, but wait, I already have my retirement covered by the state. Why bother? Well, that's a rabbit hole we can stay in for an hour, but I will give you a brief overview. First, you might not have a lot of choice. Depending on how your pension system is structured, you might be forced to invest. If you are, I'm a big believer that if your money goes to buy assets either way, you might as well learn how to pick them, spend as little as possible on the mandatory pension plan, and do the rest of the investments yourself. The majority of the investments the pension funds make are heavily regulated. They invest in very low growth assets and quite honestly are forced by the government to do so. The main reason for that is that a lot of governments are financing themselves by keeping your pension money in government debt instruments, which is something you generally want to avoid. But more on that later in the series when we talk about bonds. Second, if you have Social Security or any other type of government-backed pension, that's fine, but you have 2 major problems. The first one is lower birth rates. Almost everywhere in the world, population is getting older. That means that there are less and less working adults having to pay more and more older people in order for the government's retirement system to keep functioning. In time, this will probably mean reduction in pension payments or at the very least, big increase in the retirement age. Otherwise, the math just doesn't work. It is impossible for 1 working adult to support 2 children themselves and 3 retirees. So either retirees will have to retire later, receive less payments, or we need to pray for the robots to come save us and work instead. The second is that the currency you will be paid in, be it dollars, pounds, euros, whatever, is getting devalued every year way more than you get increases in your payments. This is a hidden tax that slowly and silently confiscates part of your money while the government keeps printing. So while your nominal pension payments or the payments expressed in absolute numbers might have increased, their relative purchasing power or what you are able to buy with them will have decreased. Which leads me to the fourth reason to invest: to protect yourself from inflation. Everyone knows that by simply saving money in the bank, the number of things your money can buy goes down with time. For example, for the past 10 years, the cumulative rate of inflation in the USA is 30%. This basically means that if you had $100,000 10 years ago, you have $70,000 now. I mean, in your bank account, you'll still see the number 100,000, but this is just an illusion, because 100,000 from 10 years ago cannot buy the same amount of stuff. And it's pretty much the same or even worse in Europe and other countries. And this is the official statistic, which is very heavily disputed among economists. I have heard different experts calculate that for the average person, actually, that 30% loss in purchasing power occurred since COVID, so a much smaller time frame. Now, imagine that the government passed a new tax. From tomorrow, you are paying 5% per year of the total value of your savings in taxes. And that's on top of all the other taxes. You will be furious, right? But somehow, if the prices go up with 5% every year, people don't seem to care that much, because the amount they see in their bank account doesn't change, and they're not actively paying money to the government in the form of tax. However, it is basically the same. So, now that we established that you don't want that, how do we protect ourselves from inflation and the loss of our purchasing power? Through investing. You see, when you keep your money in a bank or under the mattress, it doesn't work for you. But when you purchase a piece of property or a well-run company, it generates cash flow and appreciates in value, allowing you to not only keep up, but even beat inflation. And the fifth and final reason you might want to invest is reserved only for the long-term thinkers, for people who want to leave some form of wealth to their children. As we already established, if you just save money in the bank or receive social security payments, in a couple of decades your children will have nothing. However, if you invest wisely, you'll be able to give them a major leg up in life and could even be remembered as the founder of a family fortune. And I know, it sounds weird and bombastic, but hear me out. Even if you invest part of your salary for a few decades, then live from the income without selling your investments, and then your children inherit your assets, you could still be giving them millions of dollars if you invest wisely. Just $1,000 invested in a very, very basic fund like the S&P 500 in 1920 would have grown to $2,193,000. And that's inflation adjusted, so it means real money. Imagine if your great-grandfather had done the same. How much easier and richer would your life have been? Well, you can give that to your grandchildren. I don't know about you, but that's extremely motivating to me. Alright, now that you know the 5 major reasons for investing in the first place, what can you even invest in? Next, we will see what types of assets and investments exist and how you can take advantage of them. Okay, so you're already convinced you want to start investing. The question is, in what? Search Google for types of investments and you come across that. Whoa, alright, since I don't want you feeling like this, I promise I will simplify the different types of investments there are. You see, if we peel back all the complexity, there are 2 categories of assets you can invest in. And in the rest of this video series, we will explore them. The 2 categories are cash-producing assets and insurance assets. Mind you, these are terms I have created in order to simplify the idea, not the official ones. Here's what I mean. Cash-producing assets are assets that pay you for owning them. This means that you invest in them and you either receive money in return or the asset generates money and that money is reinvested back in it. Insurance assets are not what you think. We're not talking about insurance policies here. Why the name then? Because just like insurance, these are assets that you buy hoping you will never use them. More on that later. Which are the main types in the category of cash-producing assets? Credit, real estate, and stocks. Let's go over them briefly. By credit, I mean any type of lending product where you lend money and receive interest in return. You can lend using a peer-to-peer platform, you can lend to your neighbor Joe, or even to the government or corporations. How do you do the last one? By purchasing what's called bonds. Bonds are issued by governments or corporations and are used as a credit instrument in which you as an investor can lend them money and receive interest in return. Real estate is pretty self-explanatory. It's either land or buildings that are used by a person or a business, and in return for giving it to them as an owner, you receive rent from it. Stocks are simply businesses that are public and open to anyone to invest in them. These companies produce some kind of a product or a service, or in other words, value for society. If you own little pieces of them, known as shares, you're a shareholder. As a shareholder, you own a portion of the profits these businesses make. We'll take a deeper look at this category and these 3 types of assets later in the series. For now, let's move to the second category, the insurance assets. As I said, they're called insurance because they aren't productive, meaning they don't generate any cash. They're purchased because they protect their owner from bad events like wars, hyperinflation, geopolitical crises, totalitarian governments, and other things like that. Insurance assets are often overlooked or even frowned upon, but they are an important part of each person's portfolio. So, let's take a closer look at them in the next video from our Investing for Beginners guide, which you can check by clicking the video on your screen right now.